Today's hearing is entitled Regulatory Whiplash, examining the impact of the FSOC's ever-changing designation framework on innovation. We're holding this hearing after the FSOC finalized its revised guidance for non-bank financial company designations in November. The new guidance is intended to enhance protections for our financial system, but in practice, this revision paves the path for potential abuse and unintended consequences and raises serious questions about whether FSOC is taking the best approach to actually address systemic risk. For example, it removes the requirement for FSOC to conduct cost-benefit analysis when evaluating an entity's potential to pose systemic risk under a Section 113 designation. Even the district court in the case MetLife versus FSOC, which considered the legality of MetLife's prior designation as a systemically important institution, stated that the refusal to consider costs of the designation to MetLife was arbitrary and capricious. The revised guidance flies in the face of the district court's opinion and the Supreme Court precedent underpinning that decision. Not only that, but the new guidance also rejects the approach taken under the prior administration to implement a more appropriate designation process, which includes an activities-first approach and a commitment to work with the primary regulator. I think what's really damaging, too, is the constant whiplash every time that we have a change in the occupant at 1600 Pennsylvania Avenue. Just this morning in the Capital Markets Subcommittee, we dealt with precisely that same issue on the Department of Labor fiduciary rule. I'll remind all of us that on our third designation framework in 3 administrations now. And though the new guidance states that it aims to establish a durable process, it seems that this pattern of 3 changes in 3 administrations is anything but. In this Congress, our committee has scrutinized the repeated and proactive efforts by certain Biden financial regulators to take aggressive agency actions against disfavored industries through guidance, rulemaking, supervision, and enforcement. And I would argue that FSOC, which is mostly comprised of those same regulators, is taking a similarly mistaken approach with its revised guidance for designations. Let's look at the 2023 annual report. FSOC considering digital assets as a priority. And as recently as October 2022, FSOC recommended that Congress pass legislation to establish a comprehensive framework for stablecoins and that a new federal regulatory authority should be provided over spot markets for digital assets that are not considered securities. Well, look, that's what this committee has been working on since this Congress, the 118th Congress, was initiated. This subcommittee and our full committee have done precisely that. We've crafted a regulatory framework for digital assets, and we've crafted a regulatory regime for stablecoins. We don't need FSOC to be involved in that. What they need to do is support our legislative effort. And I'm proud in both those efforts, both on stablecoins and the regulatory framework, that we had a very strong bipartisan effort working with both Democrats and Republicans to craft that approach. We moved these bills out of committee, and we look forward to continuing the work with our colleagues on the Hill and the administration to move that legislation forward. FSOC needs to tread very carefully when entertaining the idea of sidestepping Congress and congressional intent. FSOC designations here, in my view, are not the proper approach a legislative fix is. It's clear some rogue regulators threaten consumer protections in the digital asset market as much as any bad actor. I think we just witnessed the latest in Washington's technological vulnerabilities yesterday and a real low point for the SEC. Chairman McHenry, Subcommittee Chairman Wagner, Hazanga, and myself will be sending a letter to Chair Gensler today to start the process of getting to the bottom of how it happened that the SEC Twitter account was hacked and investors were misled yesterday on the subject of an ETF being approved for digital assets in Bitcoin.